Hey guys, welcome back to a brand new episode of What's Happening, the show about the latest happenings in the world of crypto. Markets recovered ever so slightly this week from the bloodbath of last week, and on Tuesday, Shark Tank's Kevin O'Leary shared in an interview why there's trillions of dollars waiting to enter the crypto space, how investors should view crypto, and his own portfolio allocation. He shared a lot, so I'm going to do my best to neatly package them into sections and unpack them a little bit. And whether or not you believe that he's a credible voice in the market, given his involvement as an institutional financier, it does provide some insight to how institutional investors are behaving towards crypto, which will massively affect the markets. So let's dive in. Section 1. Could there really be trillions of dollars waiting to enter crypto? In his interview with Yahoo Finance, O'Leary said that in his interactions with institutions, many of them have yet to even go near crypto, leaving trillions of dollars on the table. But is he right? According to a study by the Harvard Business Review, institutions own about 80% of the S&P 500, amounting to about $27.1 trillion. This is in the S&P 500 alone. In comparison, the market cap for Bitcoin is $1 trillion, and the market cap of the entire crypto market is $3 trillion. Deploying a mere 10% of that, $2.7 trillion, quick math,
-1, that's free, quick maths,
would skyrocket crypto prices should these funds be deployed in tokens. So why isn't the funds being deployed into crypto? Well, Kevin, first name basis and all, explained that when he first entered the crypto space, which was to stake USDC stablecoin for 4 to 6% returns, he had to wait 6 months before his internal compliance and external auditors would sign off on it. And going back to the fact that he owns businesses in mutual funds and the ETF space, there's just a lot of red tape. Given that the US isn't as progressive regarding crypto as many other countries such as Canada, UAE, Switzerland, and even Singapore, the lack of clarity when it comes to regulation actually makes it harder for institutions to invest in it. With some level of regulation, compliance requirements would actually be easier to overcome for these folk. Without it, the barriers are actually quite astounding, and waiting 6 months is a long time for institutions. Hopefully the US wakes up their idea and starts to view cryptocurrencies with a more welcoming tone. Section 2. I bet you forgot there were sections, right? Section 2. How should investors really view crypto? In the same interview, O'Leary urged investors such as venture caps to view crypto as software as opposed to currencies.
The real decision is if you're willing to invest in software because it's a productivity tool as an equity, such as Google, why wouldn't you invest in software such as Ethereum?
While he got some flack online from the comparison, he's actually not wrong. There's 2 reasons for that: price action and application. Tech stocks are historically volatile, not unlike the Bitcoins and Ether of today, and most of them are traded based on growth metrics rather than actual earnings. According to him, tech stocks that he's held typically see 40 to 50% corrections each year, which provides an opportunity to deploy capital and essentially buy the dip. Sounds familiar? And if you look at investor sentiments towards tech stocks, they tend to rely more on the growth potential of said stocks as opposed to financials like earnings and revenue. That same principle can be applied to the potential of cryptocurrencies becoming even more recognized than it is today. And if people are investing in tech companies because they are software with the potential to scale and reach mass adoptions, then institutions should also view Ethereum and other blockchains like Polygon in the same light. How so? Well, most of us actually use the term Ethereum slightly erroneously. Because that was unnecessary. We use it wrongly, basically. So anyway, Ethereum isn't actually a currency, it's a digital platform. Ether is what we buy on exchanges, and it's the fuel that powers the Ethereum network. So with smart contracts on the Ethereum blockchain, developers are able to build decentralized applications, or dApps for short, which are essentially open source software and one that eliminates the need for middlemen. Those of you who are into the DeFi space earning interest by providing liquidity, well, that's a form of an application built on a blockchain platform. Software. So perhaps with the right paradigm shift or mindset change, when those institutions that still view crypto as a forex start viewing crypto as more of a volatile, high-growth stock market, perhaps we'll start seeing more of a shift in capital into the crypto space. And last but not least, Section 3. Allocation. When it comes to allocation of his portfolio, O'Leary explained that he applies the same rules of diversification as he does in his stocks and bonds, which according to him is no more than 5% in one position and no more than 20% in one sector. Crypto, by the way, takes up 10% of his company's portfolio. Whether or not that's applicable for retail investors like you and I is really down to our own risk appetite. But what it does remind all investors is to always be mindful about looking at crypto with the lens of your entire portfolio and to have a strategy as opposed to blindly buying the flavor of the week. That's all for this week. If you're new to Chain Debrief, be sure to check out our Telegram community, check out the resources on our website, and subscribe to this channel for all things crypto. We'll see you in the next one. Bye bye.